So this last week, we only had really one big event that mattered, and that was the jobs report on Friday. We'll look at a brief outlook for what's coming up this next week, and then where I think the market and rates may be headed. So with that, let's jump in. Okay, so we'll take a look at the unemployment report from Friday. We had 22,000 jobs, which was actually less than anticipated. So that did have an effect on rates. We'll look at that here in a minute. There was some downgrades from a previous month, June. Actually, they lowered the jobs ad. It was positive. It actually went negative in June once they had more data come in. And then in July, they did have a revision upward. But August was only 22,000 jobs added. Let's go take a look at some of the data. Civilian labor force actually increased 436,000. The number of unemployed people increased on the household survey, 148,000. So we do have an unemployment number now of 4.3%. Looking at average hourly earnings, you had a 10-cent increase from one month to the next, which represents a 0.3% increase. 3.7% year over year for the last 12 months is the average hourly increase. And that's actually not bad. It's getting smaller and smaller, and that's going to be good for inflation. Going down a bit further, this here, you got less than a high school diploma. You actually had a drop in workers of around 400,000. You'd kind of expect that this time of year because less than a high school diploma, you're going to expect that a lot of people are going to be going back to school. High school graduates, no college, actually increased pretty good amount. Some college stayed about the same, really no change there. And then the bachelor's degree, which that actually had a nice increase of around 400, 500,000. So the distribution of workers, drop in high school diploma, a huge increase in high school grads. You would want to see a bigger increase on this because it's going to have a little bit better effect on the economy than, say, the high school graduates. But let's just keep going. Look at this. For foreign-born household, you have the employed. Look at these two numbers here. From August of last year to August of this year, almost 1 million workers smaller. This is related to the deportation. The number of workers actually decreased by 800,000. Multiple job holders is another thing I like to look at. 8.7 million, 8.8 million workers, multiple job holders, up from 8.3. It's not the highest. It was 8.8 at one point. So there's some seasonality here, but this number I like to keep an eye on because this just shows how strained the American families might be becoming. Going down a little bit further to the establishment data, I like to see what industries are impacted. So there's the 22,000 job ad. That was 38,000 in private. That means government had negative growth. But look at goods producing, negative. Look at all these numbers that are negative within mining and logging. Construction had a decrease. Manufacturing had a decrease. Non-durable goods, an add of 7, so really no change there. Within trade, 11,000 decrease here. Retail trade, maybe some seasonality here with 10,000 jobs added. Transportation, 3.6. IT, -5. Professional and business services, -17 here. One thing I do like to look at here is this management of companies and enterprises. So if you look at admin and support and waste management. So administrative support right here. This is like, think of your admin assistants and stuff. So that's a -13. Employment services, another thing that I like to look at. Temporary help. These things are all important to me. A -12,000. So think of these as your recruiters. So this tells you that companies aren't adding recruiters, which means they're not hiring. Office admin support, all of this area, these are the areas that are going to drop first before you see a hit on unemployment, which is what I've been noticing over the last several months. You can go look at the last several months of unemployment reports. I've actually talked about this before, and you are definitely seeing some declines here. So that just means that future there'll probably be negative jobs growth. And that'll be what probably will bring us into a recession if a recession is coming. Private education and health services, 46,000 jobs added here. No surprise here. This is education and health. With the aging population, healthcare sector has been consistently adding jobs for a long time. Going down a little bit further, leisure and hospitality, 28,000 jobs added there. And then within government, there it is, 16,000 job decrease. Federal, 15,000. State and government, -13, and then local government is 12, and that was related to mainly education, which no surprise there. October is going to be an interesting month. I've mentioned this before, where you have the jobs from the government that were laid off back in the January, February timeframe. Actually, there was a memo that went out February 26th where most of the people were laid off. There are about 400,000 people between February and March. That will probably show up more like November. Right now, those workers are not being counted in unemployment. So what will be interesting is how many of those government layoffs have been able to find jobs. If they haven't, and right now, let's just say half have not. I just did a quick calculation. Unemployment would be, instead of 4.3, it'd be 4.5. So if they're still living on severance, they're not added. We'll see what happens in a couple of months. All right, that should bring us to the end of this report. Yep, those are the things I'd like to take a look at. Taking a look at rates, here's what happened on Friday. We are now 100% saying that rates are going to fall the week after next, September 17th. There's actually a slight chance that it could drop 50 basis points, but right now, 90% chance, 89% chance of a 25 basis point cut. I think that's correct. Given the data, unless we see something crazy with inflation, I don't expect any more than 25 basis points, but some people are pricing in a 11% chance. And then another cut in October, another cut in December. So right now we have 3 cuts priced in. That is how the market moved on Friday. It was a big day. You guys know I'm long on the short end, so this was a good day for me. The overnight rate increased, and the 2-year, which I'm actually holding the 2-year, that actually increased as well. I am still long. I will still stay long because I think the inflation job is done. Now, one thing to keep in mind, this is the short-term rate. So if you take a look here, and I'm going to draw this out, the Fed controls the overnight rate, which is this spot right here. So if I was to look at, this is the overnight rate, 1 month, 3 month, 6 month, so on and so forth, 10-year. This here is the only thing that the Fed controls, is this overnight rate. That right here, when they drop that, that'll be probably 4.08, because right now it's 4.33. So when they drop that, it'll be 25 basis points. It'll drop to 4.08. So the yield curve currently looks like this. What will happen with this 10-year, just because this drops does not mean the 10-year will drop, which means it doesn't mean mortgage rates are going to drop either. Now, there was good news this week. On Friday, we had the largest mortgage rate drop that we've had in the last 3 years. I don't expect it, though. Just because you get a drop here does not mean this is going to fall. I think, in fact, you'll probably see that 10-year rise a little bit. As this place drops, this will rise because there is some inflation expectations built in. So right now, this is right around 4.09 as of Friday. Mortgage rates are like 6.2 on average. I don't see that falling much further because that's your 2% spread that you get in between these guys. And if the 10-year retreats and goes back to, say, 4.25, you'll see this go back up to like 6.5. So mortgage rates probably won't change much, even though you have 3 cuts priced in by the end of the year. Let's take a look at the market. So on Friday, when that jobs report came out, initially it responded positively. The market actually went up probably 20 points and then fell about 1.5%, and then retreated back and then settled around the 648 mark. So it was kind of a wild day. I did short the market. Every one of these shorts, actually, I've done well on each one of these. I started shorting back in here when this dropped. I rolled positions down and then took profit, got out of it, waited for it to come back up. I did the same thing here, and I did the same thing here. I actually thought about leaving it and seeing what happens over the weekend, but I had a feeling that there might be some chance that it could go back up. If we hit 6,500, it's at 648. If we hit 6,500 or maybe 6,520, somewhere along in there, I will probably short again, because you do have a seasonal component here. That September is usually the worst month. That's not a reason to short the market, but it is a seasonal aspect, a seasonal trend. So we'll see if it holds. But some other interesting things is you've got some divergence here with the relative strength index. So things are weakening under the surface. Now, from a market breadth perspective, it's mixed. From a put-call ratio perspective, it's also mixed. Put-call looks like this. The more people buy puts, the higher the put-call ratio goes up. and then it drops, and here's where we are right now. We're kind of in this little spot right here where we're sort of flattening out. We are, if the market craters, you'll see more puts being bought because there's this expectation. It's kind of a contrarian indicator. Right now, it sort of looks like this. That's one of the reasons why is this had actually showed a sell signal, which was why I started shorting the market. It is actually a pretty good indicator that I like to follow. But right now, it's kind of in the middle. I don't know if it's going to go up or down. So you've got market breadth that's mixed. You've got some seasonal trends that are pointing downwards. You've got relative strength. It's some negative divergences going on with the market. You've got MACD on a sell signal. What else? You've got a strong upward momentum, but some things underneath the surface that may be churning. On one hand, you've got a negative jobs report, which is going to potentially hurt the market. But on the other hand, you've got a positive rate outlook, meaning rates are coming down, and that's always good for equities. So it's definitely mixed. If you are shorting the market, play this one very, very carefully. That's why I'm taking profit when it just drops a little bit. If we see any kind of pullback and this drops to say, 2, 3, 4%, and let's say we get down to the 6,200 mark, maybe the 6,000 mark, somewhere along in there. If that happens, I will be going long because rate drops are good for the market. And I will enter long positions, and where I've capped my upside here, I will be capping my downside. And then I'll be actually reversing. In the meantime, while I'm waiting, I'm actually straddling the market. I've got positions here and I've got positions here that take advantage of time decay. That's how I'm kind of working this. It is a complex environment right now with no clear direction. What's coming up this next week that could affect the market? You've got the annual revision. So last year we had remember, 1,818,000 jobs lower than what was previously reported. That's going to happen on Tuesday. Who knows what's going to happen, whether we're going to get more downward revisions. Typically, over the last several months, we've seen several downward revisions. What does it look like annually? Not sure. So that could probably move markets. You also get PPI, Producers Price Index, which is a level of inflation. We get that on Wednesday. And then we get inflation CPI on Thursday. And then Friday, we get Mission Consumer Sentiment, which all of those will have an impact. My guess, if you were to ask me right now where the 10-year and the 20-year rates are going to go, I would say they're going to go higher. The market responded very favorably on Friday, and they dropped a lot. I do expect them to retreat a little bit and go back up because you still have the debt problem to deal with. And then if you know that rates are going to be coming down faster in the front end, you've got inflation expectations built in, which is going to drive the 10 or the 20-year up higher. So I do expect them to retreat a little bit. That can all change on Wednesday and Thursday if inflation comes in benign. We've got the tariffs, and the impact of the tariffs are still working their way through the system. So remember, we talked about that one-time price bump. That one-time price bump, when I say that, is going to be over a period of several months. So 3 to 4 months, you'll see that bump, and then you should start seeing it drop. Keep an eye on that one because those are high-risk days for rates and the market. That is it for this week. Thank you so much. If you like these videos, please let me know. Send me some notes, some questions, or anything in the comments, and subscribe. Thank you very much. Have a good one.